Okay, it's just about 4 o'clock, so let's get started so that everybody can, so that if there's anybody here on the right coast, can get home for dinner. What we're going to talk about is we're going to talk about the new repair regulations that were issued back in September. And there's my ugly picture, along with all my irrelevant initials and all of my contact information. The easiest way to get a hold of me is you can use either of the email addresses. I check both my Greg Rand Gray email address and my personal address. The best thing to do, though, is to call my cell phone, which is down below. I do check my voicemail, but calling my cell phone is usually easiest way to get a hold of me. Those of you who know me know that as a matter of policy, I try very hard not to make political statements. I'm going to break that policy slightly a little bit later in one particular area. Feel free to, if you ask questions, you can ask whatever questions you want and be as political as you want. And as long as it's not too outrageous, I will indeed read it so that you can type those in. Those of you that know me know that I've been adding this slide. It actually goes back about 40 years ago to my old mentor back at Coopers and Lybrand. It says, "Don't let the tax whale wag the economic dog." That's really important in this situation because what we're going to be talking about is really an entirely new way of looking at whether or not an expenditure for an asset should be capitalized or expensed for tax purposes. And, that's going to, for some people, change the way a lot of people do things and what a lot of people are going to have to do in order to comply with all of these regulations and rules as we go by. So why is it so important and why are we talking about this now? As I've been talking to various people over the last few weeks, they all say to me, "Hey, Mike, who cares? I basically take and depreciate all of my additions because I either take it as 179 as a direct expense, or I get bonus depreciation, or 15-year life on my retail or restaurant property, and so on and so on." So we have these things that we think we've had, but there's something you have to understand. All of these expire at the end of this year, and as of now, if nothing changes, 179 is going down, so you only get $25,000. Bonus depreciation goes away. 15-year depreciation goes away. We have all kinds of other extenders that we have to talk about. Although there is nothing happening at the moment, what most people think is going to happen is that 179 is going to wind up somewhere between what we have now and $25,000. Bonus depreciation will not be renewed. We have no idea what's going to happen with 15-year depreciation or the other 20-odd extenders that we have. So that basically what we've been told is not to expect anything to happen before year end, probably nothing to happen in the first quarter of 2014, and so whatever's going to happen is going to happen later in the year and be retroactive. I obviously have a real problem with that. I like to know what's going on. I think business people like to know what's going on, but that's the situation we find ourselves in. So let's talk about the repair reg. First thing you have to know is that the new repair regulation is effective for years beginning on or after January 1st, 2014, which means you have about 2 months to get ready for what for many people is going to be a major change in the way they decide whether or not an asset expenditure is capitalized or expensed. So let's move forward. First thing you have to understand is we have a new concept, and the new concept is called unit of property. And we have unit of property both for buildings and tangible assets, and let's talk about what the units of property are for a building, because although these were similar to what was in the 2011 proposed regs, it is important that you understand what is and is not in there. So basically what we have is HVAC, plumbing systems, electrical systems, escalators, elevators, fire protections and alarms, security systems, gas and heating systems, and anything else the IRS deems it necessary to designate. Now you'll notice that there is something that is not in there, and that's the roof. The roof is considered part of the building, and we're going to talk about the importance of some of the things that we can do as far as what we can do for roofs and other things. Now, all of you are sitting here and saying, well, who cares about a unit of property? We care about a unit of property because a unit of property means that should you make this unit of property go away, so for example, if you have an air conditioning unit on the roof of your building and you go to replace it, you now will be able to take that unit of property, that air conditioning unit, and expense whatever is undepreciated. And you're now going to tell me, Mike, I have no idea what the basis of that is. We now go back to many of you who own buildings had cost segregation studies done when you either built or purchased that building. However, that cost segregation study really didn't come along and identify these units of property. Now, what I have been told by friends of mine who are experts in cost segregation study is that if the cost segregation study was done efficiently back then what you're going to have is that you're going to be able to sit here and they're going to be able, from the information they have, they're going to be able to pull that basis out for each of these items. And that's something that you're going to want to consider if you had a cost segregation study done before. Talking to whoever did it, see how much they would charge you in order to break out into these new units of property, as well as with roof and certain other things. And that's something that we can talk to you about as to whether or not it makes sense to do it or not make sense to do it with specific buildings. Unit of property also applies to things other than buildings, tangible property. And basically what it talks about now is it talks about plants, which are discrete major functions inside of a building. And then it talks about machinery and equipment. And we now have a relatively new concept. And that concept is interdependence of machinery and equipment. Now, I'm not a manufacturing expert. I'm sure there are people out there that know a lot more about manufacturing than I do. However, what I do understand from long ago with an internship in high school is the concept of one machine starting something and the next machine picking it up and moving it along, so that each machine along the way was dependent upon what the previous machine and the next machine did. So what they're now saying is that all of those machines that are interdependent are now a unit of property, and you have to bring them together. And that becomes very, very important when you talk about repairs and maintenance of any one or all of them and a disposition of one or more of those machines. With regard to networks, computer assets, basically we have a facts and circumstances unless guidance is provided. We've been told there won't be any guidance provided in this area for several years. So that basically what we're looking at is that all your wiring, routers, modems, and so on are all part of your network assets and are all part of one unit of property. Now, the reason I have leased assets down there is that you have to remember that capitalized leases for tax purposes and capitalized leases for GAAP purposes are not the same. There are different tests that have to be done, and if you have a capitalized lease for tax purposes, then all of these rules will apply to those capitalized leases. So what about improvements? What if I improve an asset? First thing we have is we have a new word, and the new word is betterments. So that basically we're going to talk about specifically what a betterment is in a few minutes, but the first thing that comes down with regard to improvements is a betterment, and we have some slides to talk about betterments. The next thing is a restoration, and a restoration is something that brings a piece of equipment, that brings something back to its original functioning value. So for example, if you have a truck and you rebuild the engine so that it is now back functioning at its original efficiency, that's considered a restoration. All right. Now, adapting to a new use. So if I have a machine, for example, and long ago, for example, I had an internship where I was with a plating company, and we were plating things for a certain thing for the military. That contract ran out. Things had to be retooled in order to do plating for a different thing. In that specific case, what you have is you have a plating situation where there was change and the use was different. It was a new and different use. Therefore, the cost of that would have to be capitalized. So what is this new word? What is this new concept of a betterment? All right. And I don't want you to think that I'm this smart or I was an English major or anything like that. I did not come up with the word ameliorate myself. It was clearly part of the regulations. So basically what they're saying is that it ameliorates a condition. All right. So basically what we're saying is ameliorates a condition means that it fixes a condition. So something has happened to a machine or whatever whereby it is no longer functioning properly, and you are ameliorating, you are fixing the condition to bring it back up. It's almost like a restoration, except the restoration is done specifically, whereas in this case it is something that happens accidentally, so that you are fixing that condition to bring it back up to functioning. Now we get to an interesting concept, and that is the betterment, is the amount that's involved a material addition? Is it a material cost? Now, there is really no materiality concept in tax the way there is in general accepted accounting principles. So that basically one of the things that we're going to be looking at as we talk farther down the line about the amount of money that we're talking about in capitalization, think about that in terms of, is this betterment a material addition when we talk about specifically, when we talk about what the de minimis rules are, and does that make things material or not material based upon the new de minimis rules? And the last thing, is it reasonable to expect to materially increase the productivity, efficiency, output, or quality? In other words, does it make it better? So does the investment that you're doing make it better? Even though it was functioning properly, it makes it more efficient, faster, better quality, whatever. If that's the case, it is a capitalizable asset. Okay. Routine repairs and maintenance. We have a safe harbor. Let's talk about the safe harbor first for tangible personal property. Safe harbors and de minimis here are very, very important concepts as to what you're going to have to do and not have to do. So the first thing is it necessary to keep the unit of property in normal operating condition? So that basically what we're saying is, let's go back to our example of a truck. All right. If I have a truck or any other motor vehicle, I have to do routine maintenance. I have to change the oil. I have to change the oil filter, et cetera, on a regular basis in order to keep that truck in a normal operating condition, which brings us to the second part of this. And it is only expected to be performed not more than once during the normal life expectancy. I want to focus first on the last three words, normal life expectancy. Normally, we as tax people talk about depreciable life. Now, a depreciable life is an interesting concept, but if you really think about it, what a depreciable life of something is and what its normal life expectancy is, in a lot of cases, really are not the same. But what this is saying is we are not talking about that something is only expected to be done once during its depreciable life. We're talking about its normal life expectancy. So one of the things that I'm suggesting to people is that if they make a significant routine maintenance, right, that is going to happen once during its normal life expectancy, that you somehow document why you expect that to be the normal life expectancy, what you expect its normal life expectancy to be. As of this time, we have no guidance as to what the term normal life expectancy really is. With regard to real property, this is something that those of us who were dealing with Treasury and the IRS and wrote comments and talked to them and so on, fought very, very hard for, and we think it's really, really an important concept. We now have a routine maintenance safe harbor for buildings, for real property. And basically what it says is that if you are doing routine maintenance and it's only going to be done once in 10 years, then you can expense it. Now, I'm not a real estate expert. I'm not a building expert. I'm not a contractor. I don't understand or know those things. That's not what I do. But those of you that are in the real estate business, if you are doing significant maintenance and you expect that it would only be done once in a 10-year period, it is really important that you document why that's the case. Because what is important is that even if it has to be done for some reason, a second time during that period, if it could be reasonably expected only to be once in the 10-year period, then you can still expense it. So this is something where, once again, I'm a believer in document, document, document. This is a situation where documenting things is really, really important in order to properly preserve that you can expense things as routine repairs and maintenance. Okay. Let's talk about materials and supplies. And this got interesting because I was talking to a friend of mine up here in New Hampshire with regard to some of this, and he kind of caught me by surprise with something. And let's talk about materials and supplies. And the first thing is that it's tangible properties that is used in a trade or business that is not inventory, and this is the important and here. And is acquired to maintain, repair, or improve a unit of property, is fuel, lubricants, etc., that are expected to be consumed in 12 months or less. And this is the part that actually caught me a little by surprise when I was talking to this person, because I always think of lubricants and so on as something that, you go down to your corner ADP or Walmart or whatever, and you buy 5 quarts of oil and you put the oil in the oil filter in your car or whatever, and that's what it is. And he said, no, Mike, that's not what happens necessarily in the business world. In the business world, we could be buying lubricants, and because we get it volume discounts and significant volume discounts, we could be buying lubricants and other things that actually last for more than a year. And if that's the case, all of a sudden it's out of the concept of materials and supplies and something that may have to be capitalized. And that's something that we're going to have to take a long, hard look at as we're dealing with this. And the last item is that the unit of property has an estimated life of 12 months or less. So that basically, when we're buying things and we're saying that it is a material or a supply, it is something that only has a life of 12 months. And here's the last one, and this is a situation where those of us that were dealing with Treasury and making comments and so on, I guess we call this a partial win. Initially, the Treasury wanted to say that anything with a cost of $100 or less could be a material supply. We all said that was just a ridiculous number, that $100 is nothing in today's world, that we were fighting for $500 or $1,000. They came back and gave us $200. But think about what this is saying. This is saying that anything that you buy with a cost of $200 or more, you're going to have to defend why it has a life of 12 months or less. Right? Or anything that the IRS gives us guidance on, and right now there's no further guidance in this area. Now, we now come to the de minimis safe harbor. Everybody knows de minimis is a great word. It means very little. Right? And what is going to happen here is that there's some very interesting, different de minimis rules and some new definitions that you're going to have to pay very close attention to. Number one, and this is the big kicker. In order to qualify for any of the following de minimis rules, the business must have a written capitalization policy by the beginning of the year. So that means that in order to use these de minimis rules, you have to have a written policy in place by January 1st, 2014, assuming you're a calendar year end, which doesn't give you a whole lot of time to do this. Now, I will tell you that as of today, there are not, that I know of, any real pro forma fill-in-the-blank capitalization policies. We've spoken to various organizations and are hoping that we will have some pro forma policies that we can distribute to our clients and friends by the end of this month so that they can meet this qualification. But it's very, very important, and we see it over and over and over again. And having that written capitalization policy is going to be key. And that policy has to indicate that an amount is paid for less than the thresholds, and we're going to talk about the thresholds, and the property has a life expectancy of less than 12 months. So that written capitalization policy has to indicate that it's an amount paid for less than the thresholds we'll talk about, and it has a useful life of less than 12 months. We now come to our next definition, and that is businesses with an AFS, that's applicable financial statement, and we're going to talk about what an applicable financial statement is in a couple of minutes. If applicable financial statement that has a written capitalization policy has a capitalization limit of $5,000 per item or per invoice. So think about what that says. That says that if you have an AFS and you have a written capitalization policy, and it's something that lasts for less than a year, no harm, no foul, you can just arbitrarily, nobody's ever going to look at it, expense any item that costs up to $5,000. However, if you do not have an applicable financial statement, that $5,000 is reduced to $500 per item or per invoice. So obviously, definition of applicable financial statement, which we'll get to in a minute, is going to be extraordinarily important. This is an annual election which is made with your tax return. The IRS is going to provide us, they tell us, with basically a statement that we will attach to your tax return a year from now. When you file your 2014 tax return, we'll attach a statement that says, yes, you are electing this year and this year only to use the de minimis safe harbor. You don't have to do it. You can do it. It's up to you. The statement has to be attached. And if you don't use it, you can change year to year. It's not considered a change in accounting method. One of the things a lot of people were very, very concerned about is in the initial regulations that came out in 2011, there were well over 120 possible changes in accounting methods, and people estimated that over 90% of businesses were going to have a change in accounting method filing on a regular basis. We don't know what's going to be coming out. One of the things that we have been told is that sometime between, well, it's probably not going to happen today since I haven't seen it, between next Monday and the end of January, we're going to see 3 more revenue procedures that are going to tell us in detail what we have to do, and one of those is going to come out in detail and talk to us about accounting method changes and how many we have to do and when we have to do them and whether we have to phase things in over time and so on. And when that happens, we'll be sure to make sure that everyone understands what is coming down and how that is going to play out. So, obviously, an applicable financial statement is a big deal. So, this was a major loss by those of us that wrote in and made comments. I was on the AICPA committee that made comments. I didn't write this particular area, but I know the people that did, and I know a lot of people that did, that disagree with the IRS and what their position was in 2011 and continues to be now. So the first thing is that an applicable financial statement must be an audit. Please understand, I'm a tax guy. I'm not an auditor. I don't know how much audits cost. I don't know how much more an audit costs than a review. I know it is significant, but this only applies to audits. It does not apply to reviews. It does not apply to compilations. However, it doesn't even apply to all audits. It applies to audits that are used for credit or reporting purposes, or a financial statement that's required to be filed with the Securities Exchange Commission or some other governmental agency. All right, so basically what we're talking about here is that, if you have to do an audit for the bank, I don't know if there's anybody on this call, I doubt it, that has to file with the Securities Exchange Commission or some other governmental agency. But basically, for all practical purposes, for most mid-market people, this is going to be because the bank is forcing you to do an audit, and that's why there's an audit being done. And that audit is now an applicable financial statement, which means that you have a $5,000 limit instead of the $500 limit. So should you get an audited financial statements? I don't have a clue. It is not my area. We have people in our office that will be happy to talk to you about what it costs to upgrade from a review to an audit and what it does and doesn't do. If you want to talk to me about exactly what's going to happen as far as what you have to capitalize, what you can expense, and how you have to do it, you have all my contact information, and you can feel free to send me an email or give me a call and we can talk about it. Now, I have a very, very dear friend who happens to be in St. Louis, so I've been giving him a lot of hazing stuff over the last few days, last 48 hours or whatever. And he has what I call an extraordinarily aggressive position. And I want to repeat the words. I consider this to be an extraordinarily aggressive position. That does not mean somebody just told me this is painful. And if you think this is painful, you should try reading it. Let's talk about this loophole. This loophole says, according to my friend, that when you go back and you looked at what the de minimis rules were, and you go back, I don't know if you have the slides, I'm assuming you do. If you go back, it said per item or per invoice. Now, we think that was badly worded, and he takes it to an interesting position. Let's assume that you have a written capitalization policy, and let's assume you have an applicable financial statement. And you buy an asset that costs $8,000. Now, based upon that, and you're sitting here, and it's an $8,000 item, which is above your $5,000 limit. His position is a little bit different. His position is that if instead of getting an invoice for $8,000, you got two invoices for $4,000, that you would meet the de minimis rules. Now, I will tell you, I consider this to be a very aggressive, underlined very aggressive position. My gut tells me that eventually the IRS is going to figure out this position and shut it down. But he does have a legitimate potential position for now. Now, the only thing I will say is what I don't want to see people happen is to go out and say, okay, you sent me this invoice for $8,000. Take the invoice back and give me 2/4. If you're going to try and do this loophole, please make sure you get two 4,000 invoices right up front. Don't try and do it after the fact. Because basically we have a concept in tax called step transactions and other things, and that's just absolutely not going to work. But if you want to talk about it, you know where to reach me, and we can talk it through, and whether or not it makes sense, and where we stand and where the IRS stands with regard to that. Okay, so basically Any purchase with a useful life of 12 months or less can be expensed, notice the red, as long as your written accounting policy said so and the cost of the item does not exceed your de minimis amounts. All right. The importance of having your accounting policy, written accounting policy, once again, I cannot overemphasize how important I think that is. And as we find things that we can use for that, we will obviously make them available. Again, please, please, please just keep this in mind as we move forward. Now, we did have one win, all right, kind of. And the win was that they have agreed that there should be a small business exception. And basically, they define a small business as a business that has $10 million in revenue, which is a pretty decent number for, Main Street's closely held business. $10 million is not unusual. There are other parts of the Internal Revenue Code and tax area where $10,000 is used as small business. So that's pretty good. However, they then say that the exception for the small businesses only applies if your repairs and maintenance, the amounts that you're including for this, is $10,000 or 2% of the basis of all the property added that year, whichever is less. All right, so basically, while we did get a small business exemption because of the low levels that we're talking about here, $10,000 is pretty good, still a pretty good number, but it is nowhere near the numbers we were talking about, for example, for Section 179. So it is something we can do. One of the things that I want to make sure of is I believe that the small business exemption should be included in your written policies, which I still think you should have, so that basically in your written capitalization policy, if you're going to qualify as a small business, we ought to make sure that your small business exemption provision is included in there. Once again, changing accounting methods. I've been talking to several people about this. Guidance is expected. We don't know what is or is not going to be considered a change in accounting method. The change in accounting methods were really painful in the old regs. We are told they're going to be not as painful in these. We have been promised guidance by the end of January. When that guidance finally comes out, we will make all of that information available to you. If you have any questions about the status or anything else, once again, you know how to reach me, and just give me a call or send me an email, and I'll let you know where we stand on that. Now, this was actually interesting, or I found interesting in my warped little tax nerd world. I would have thought that if I changed my written accounting policy, it would be a change in accounting policy. I would have to make a change in accounting method if I filed 3115, and I don't. So basically what they said is, if I change my written policy, I don't have to say that I changed my policy, which doesn't make a whole lot of sense, but basically that's where it stands within your written policy. And once again, we keep coming back to just how important having this change in accounting policy, this written accounting policy is. You have an option to go back and use this in 2012 and 2013. And your question obviously is, why the hell would I do this in 2013? And the reason for that is because of dispositions. Now, dispositions came out as proposed regulations, not as final regulations. We have been told we will have final regulations once again within the next 3 months or so, but we don't have them yet. What's important here is that, A, they are clearly going to be effective for 1/1/14, regardless of when they come out, even if they come out after 1/1/14. However, what they say is that you can have a partial disposition and write it off. And one of the examples that they give is a roof. All right. And this again, my understanding is that there's only one client that Gray Gray has that has GAA, and I think a couple of those people are on this call, and you can, call me later and we can talk about your situation specifically. But if you are not using GAA, you can make an election to have a partial disposition. And my example is a roof. So that let's go back, and again, I'm not a construction person. I have no idea how long a roof lasts. But let's assume that you bought a building. Right? The building has a 39-year life, and 20 years into the life, you have to put on a new roof. Under current rules, prior rules, what you would have to do is just keep depreciating all of your building, including the roof, and you would have to capitalize and depreciate over 39 years the new roof. What you can now do, as long as you're not in a GAA situation, is you can go, and if you can determine what the initial cost of the roof was, which goes back to our making sure our cost segregation studies were done appropriately, you can then say, all right, the undepreciated value, which you can now determine because you know the original cost of that roof, that undepreciated value can now be expensed, which is really important. So that if you had a major item in 2013, like a roof, like a machine that's in a production line or something like that, where it could be considered a partial disposition, that's something we may want to talk about, whether or not we should go back and go in and use these rules effective for 2013. And if you do have that situation, give me a call or give somebody a call in the tax department, and we can talk about that. Then again, if you are using GAA, and I think you know who you are, you cannot take any of the loss until you have a complete disposition of the entire unit of property. For any of you that were not able to attend our year-end tax planning seminars, I will be doing a year-end tax planning seminar that is going to be a little bit different, talk about a few more different things, a few other different things that have happened in the last month on November 21st at 10 o'clock in the morning. And you can obviously register on our website, and we'll be sending things out in order for you to register on that. I hope all of you have signed up for our newsletters. They're pretty good. And as important, or I think more important than the newsletters, is we send out periodic blast emails of things as they are happening. We've been doing that for years, and that's really, really important to make sure that you're getting those. Make sure that you're signed up for it, and again, if you're signed up for our newsletter, you will be getting those. Once again, there is my ugly picture. There's all my contact information. Feel free to contact me through any of those things. Just a minute, somebody just said something here. Are you sending out a recap cheat sheet? All right. Basically, if you would like a recap, if you would want copies of these slides, I can send them to you. If you have specific questions about any of these things, give me a call, and I'll be happy to go over it with you. If you email me, I will send you these slides so that you can have them, so that you can do it. Yes, please, Eileen. Okay. Yes, I will, Eileen. Again, you guys all know where to reach me. I'm here. I'm almost always available. And again, the easiest way to get a hold of me is either through one of the emails or through my cell phone. I do check my voicemail periodically, but I check my email much more than that. So if there's any other questions, feel free. If you want copies of any of this, just give me a call, and I'll be happy to send it to you.